being ranked on prop firm leaderboards and making $250,000 in payouts in a single year.
I like to class the market as a surfer going out into the ocean. You're going into the same water every single time and they're going to repeat the same practices, their strategy, but they don't know how big or fast or long the waves are going to last. So we've still got to adopt the same technicals onto the market, but you've also got to look at the nature of the market.
Introducing Scott Taylor with a decade of market experience scalping in the Forex markets and transitioning to the futures market. In this episode, Scott reveals his simple step-by-step strategy optimized for high risk reward intra-session and intraday trading.
How do you determine your stop loss size? And I say, well, it's the risk to reward that determines the stop loss size.
Oh, what do you mean by that?
So like if you get a 15-minute, I basically took out my strategy from Euro US dollar and didn't change a single thing and put it into the German DAX and the SP 500. All of a sudden, saw a massive increase in my reliability just because I knew overall, what am I trading? What's the nature of the beast? With Forex, you don't really know. It could move sideways for 3 months and then be bullish for a week and then automatically shift on a 4 hour, become bearish for 2 weeks. And every time I was shifting on the 4 hour, I'm having to sit on my hands and I got fed up of waiting. I thought, oh, my edge will play out in time. At the same time, you've got to make money.
Yeah, because we're talking about liquidity sweeps. Aside from a market structure or demand area sweep, what other pools of liquidity are relevant to you? Because we can draw infinite potential pools, not only for the entry or directional bias, but also you're talking about exit points. What is liquidity pools that you are focusing on?
Liquidity for me in simple terms is the most.
Ladies and gents, welcome back to another episode. I'm joined by a man I've been following for many years now. Glad to finally have you here, Scott. Thank you for coming down.
Thanks for the invite. Good to be here.
So one thing, there's a lot of transitions in your life, I want to say, going from a gym owner and then struggling during COVID to back against the wall and then becoming a trader. I think having your back against the wall is probably the worst thing because the markets amplify emotions. So I want to explore that later on. And also a recent transition is dabbling into futures. So just that CFD Forex versus futures debate. But first of all, I want to start off with this year alone, you've gone from personal capital to leveraging prop firms and done it very successfully. 250k in payouts in a year alone is no small feat. Talk to me about that transition from trading personal capital, which is everyone's end goal. You actually went to the prop space, so you did it the other way around. Why and how has it been in terms of difference in actually executing?
Yeah, so there was two main reasons why I decided to do that. So it was around August 2024, so about a year ago, that I decided to essentially go back to prop firms. I mean, prop firms is such a good tool from a return on investment point of view. You know, even the expensive challenges with a CFD firm, you could put $500 down to get 100k. I know you're not really getting 100k, but you get the ability to make, you know, yes, 5, 10, 50k back, a return on that investment. And even if you burn through multiple evaluations before you get funded and get the payout, the return on investment still makes sense. So the reason I went into that space is for two reasons. One, because as I'm becoming more of a well-known figure in the space, I wanted to be able to share that I can actually make money from trading, which a lot of traders can't. So going through prop firms and multiple prop firms, not just affiliating myself with one, it shows what I can do. And I've managed to do that in 12 months and I'm very happy with that. And I'll continue scaling that. And the next level, I believe, is trading futures. And then the second reason was because I'm an entrepreneur and I always have been, and my partner is also. So that trading capital that I was using at the time, why not utilize that and diversify into multiple pots and open other businesses? So I now managed to diversify that portfolio into 2 new businesses where I rent my house out to brands that pays very well. So I'm one of the very few that their home is actually an asset.
Yes.
And then secondary, my partner now has her own furniture brand.
Cool.
So I basically put that capital up front and now she's sustainable and earning more revenue for the family.
And this is the capital from payouts, or this is your original?
That was my capital, but my personal pot that I was trading. Okay. And then I put some into long-term futures, you know, the SP 500, because I'm 38 years old now. I have 4 children. I've got to think about. That shocked me
because you look about my age. Yeah.
So, you know, when you're 21, you're thinking about grafting. And in my 20s, I grafted. I picked a small business because that's all I really knew. I was not academic at school. I didn't have any degrees. I didn't go to university. I struggled with anything complex. I was not good with numbers, anything like that. So I just went to the gym because that's all I really knew, right? So I grafted in my 20s when I opened that gym, and I will talk about it shortly. And it's just a case of my kind of my 30s now, I'm thinking about the future. I'm thinking about my children's future. My youngest is 3 years old. My eldest is 16. So I'm thinking, I've got to buy her a car soon. Then it's like deposit for a house. She's going to be asking for that kind of stuff. So I'm not just thinking about the money for now. That has been the last decade. Now it's about the money for the future as well.
Now, it's very interesting how people would ordinarily think prop firms leverage that to get my own account and then use that for my diversification in life. But it seems like you've taken your capital to then have diversification to risk against the market and then utilizing the tool that the prop firm space is. I want to first start off with exploring technicals. And I've been seeing obviously your content for a while. Something that struck out was it looks complicated because you're down on lower time frames and not trading the typical support resistance trend lines. But at the same time, what shines through is it's also a very simplified approach. So if you can walk me through your philosophy in technicals.
Yeah, so I look at trading like trying to find simplicity in the complexity of it. You've got so many multiple time frames, but to be brutally honest, you don't need all those time frames. And most traders, they have families, or if they don't have children yet, they have full-time jobs or they have businesses and they're looking to trade maybe 1 hour a day. That's probably all they can manage. So it's a case of cutting out the noise as much as possible. And that works for me as well. I mean, I don't just trade. Of course, I teach people as well, but I have other businesses that I am involved in as well. Plus, I actually have a life. I don't want to sit at the laptop 7 hours a day. I'd rather trade for maybe 30, 60, maybe 90 minutes tops. If the market's really hot, I'll be there for the full New York session. But usually, because I trade off the 15-minute for entries, I set alerts and I walk away. I only come back when that alert's hit. So I look at a 4-hour time frame for market structure, and I call 4 hour my key driver. And I'm looking for trend. So my watch list typically starts with about 4 assets. So I'll have gold, I'll have the SP 500 or ES in futures, NASDAQ or NQ in futures, and then the German 30 or the DAX.
Oh, interesting.
So I'll look at them in the morning, and the first thing I'm looking at is what's cleanest in terms of a trend on the 4 hour. Is it making higher highs and higher lows with swing points, or lower lows and lower highs? Or is it consolidating? And if it's consolidating, I'll just toggle it off and I won't look at it till the next day. And it's as simple as that. And I'm spending probably 30 seconds looking at that. So we had gold in April that was creating new all-time highs until mid-April, and then we had a 95, 96-day consolidation, so it came off the list. And I was holding a swing position from like the 20th of May for like a 90-day period. Okay, the swaps on that were pretty big, but I was holding it for a long time, but not entering any new positions until we broke out again. The same with like the German DAX. The last 2 months, it's been consolidating on a 4-hour time frame, so I'm just laying off. And people that watch me, they're like, why are you not trading DAX anymore? They think I've just like completely changed, but actually it's just a filter process. So then you look at ES or the SP 500, of course it's an index, it's a trending asset and usually bullish over time. So that's like a trader's dream. And the first thing 10 years ago that I was ever taught was the trend is your friend till the bend at the end. And it's still very true now. So of course, with futures, it's more intraday, but I do like to swing trade on CFD. I'll have a swing account. Okay. So if I'm looking at trading from a 4-hour low, let's say a 4 hours took a previous 4-hour low in a bullish market, we're looking at a swing point, a run on liquidity.
Yes, a sweep on the 4-hour.
Yeah. So then if I'm taking that on a CFD, like a swing account, like a FundedPro, FTMO, or FundedNext, I'll target the opposing higher time frame liquidity, like a all-time high, a 4-hour, a daily high. Okay. Whereas if I'm trading off the 15-minute, let's say New York on futures firm has taken Asia low, London low, because I have to be out by the end of the trading day, I'm just targeting opposing side session liquidity. So I'm buying at the low of low of New York, I'll target that origin of New York high. So it's a different strategy for different firms.
So just exploring that topic alone, which is, I guess, your ideation in terms of top down or 4-hour down is probably very similar in terms of orientating yourself in a trend, trying to find a relevant sweep, and then you have the bullish targets in this scenario. But the exits are different, where one is a session related exit, the other one is a swing related or 4-hour next high related. Have you found a difference where the entry model or the ideation is similar, but the exit protocol is different, that yields maybe significantly different results, or what's your learnings in that?
So I've been trading futures only for a couple of months now, but it's definitely a good learning curve that I can pass on and learn from myself. It's more the risk management and exits. The entry is exactly the same.
Okay.
The time frames and trading, the strategy is exactly the same. But instead of being able to hold for a 4, 5, 6 to 1, it's really more of a 2, 3 to 1 maximum. Again, because you've got one, like with Apex, you've got trailing drawdown, which can be really tough. So you've got to be in and out. It's more day trading. But even without that, like FundedNext futures or Funded Pro futures, for example, that have just released, you just have end of day balance-based drawdown, but you still got to close your position before the end of the trading day. Otherwise you get liquidated, right? Whereas if I'm trading a CFD account and I get in at a 4-hour low in a bullish market on a 4-hour, I'm going to hold that until the next 4-hour structural high.
Let's take a moment to talk about a partner of the show, a leading prop firm, that is FundedNext. And it's important for me to listen to our community to see who are you working with and how can we make your experience better. And the main feedback I heard is trusted payouts, quick payouts, ability to scale, and affordable prices. And FundedNext has ticked all of those boxes, not only being a top 3 prop firm in the industry, but also having on-demand payouts, and every 10% you gain on your account, you will double your capital for free. And because in this industry, trust and reliability is the most important factor, an important guarantee that they have is that if you do not receive your payout within 24 hours, they will gift you an additional $1,000 to your payout just for being late. So to unlock all of these benefits and work with a leading prop firm in the industry, FundedNext, check out the link in the description or use the code TOT. So it's interesting because your analysis will be similar or equivalent in both. Your entry criteria will be equivalent. It's just the exit that is different through necessity of CFD versus futures. Yeah. However, I want to explore, because now you're basically swing versus intraday, intrasession yourself through necessity. So it brings into, as a conversation, what is better or more favorable, could be to your personality, could be to your lifestyle choices. But I also mean in terms of certainty or a degree of confidence, because in a 4-hour swing from high low to high high, that could last days or even weeks, and anything can happen at any point, where today that entry is valid, but 3 days, 5 days later, something politically has changed and it can reverse on you, which is something you can't predict. Just a philosophy that I have had is, as time goes on, degree of certainty naturally decays, in the sense of, if I had a gun to my head and someone said, where's price going to be in 10 minutes? It's going to be a little bit higher, a little bit lower. So that degree of certainty is within a 10, 20 pip range. So you can be confident of that. If someone says to me, where's it going to be in 1 year? It could be really high, it could be really low, or anywhere in between, alluding to the fact that swing naturally comes with a bit more uncertainty. Have you found that your strike rate is higher in the future side because of earlier exits, or your yield has become higher because you're able to enter multiple times? And any insights from this comparison?
There's definitely a correlation with futures having a higher win rate because you're cutting it at like a 1.5, 2 to 1. Whereas with a swing, you could be running 3, 4R and take more break evens for that exact uncertainty. But there's definitely some secret sauce in this, and a reason why I stopped trading Forex about 22 months ago is because at 4-hour pivot points, if you get a 4-hour that's bullish for a week or two, and then it's giving a market structure shift to the downside, and the 4 hours now starting to become bearish, you're going to take a lot more losses or a lot more break evens, or you'll just be sat on your hands, especially with trading off 15-minute entries. Whereas going into indices, which tends to be bullish on a higher time frame for months versus days or weeks, you have more reliability on being able to predict that, okay, the market is going to create a new higher high. So that's one of the biggest things in that filtering process that I'll always say to my mentees or anyone asking me for advice is, first of all, what market are you actually trading right now?
Yeah, it makes sense where a index will naturally be a tendency to be trending in a direction, whereas a currency pair is not favorable to be trending. It might be a large consolidation, but it is more likely to go sideways because that is stability in an economy, and I guess that bakes in a level of confidence in your biases. Have you found it's early days, you said, but overall profitability has been better in futures?
I would say it's been difficult depending on which firm you use. If you use a firm with trailing drawdown, I won't name names, but people will probably know what it is. You can get into profit really quick, but you get penalized by any kind of drawdown, even if it's an actual profit. So if you're running
unrealized.
2,000, unrealized.
It's crazy, yeah.
That is tough. But prop firms have to make money, and there's the difference between one prop firm might be really low entry ticket. There's a cost.
Yes.
That, if you're expecting to get a 50K, which is cost you like $25, you can't expect it to be tough to pass, right? There's got to be some kind of a hack to it. Whereas this is why I'm exploring other avenues as well. And it's still very early days of futures. I'm not saying I'm a professional with that. Absolutely not. But yeah, you can get in and out with, intraday, because a lot of the time I'll trade just New York on futures. So I find myself, if I'm buying in New York, I'm just literally targeting the origin of New York. So if Asia's consolidated, which tends to all the time, London may continue, but without taking any liquidity inside of Asia. Pre-New York Open will then continue furthermore. But if you have, it's like a 4-hour gap resting beneath Asia, or I use the initial balance of Asia, the first hour of Asia, if London has not mitigated that, you can almost guarantee with certainty price is going to come down. And if you're going to buy there and know you've got to be out of the position within 2-3 hours, your maximum target is New York highs. Whereas if you're trading on a swing account, you could literally set an alert on a 4-hour low in a bullish market, wait for price to hit that, put your TP at the 4-hour and leave it and go to work.
When it comes to these shorter time horizon profit taking, New York high, let's say, or previous session high, are you therefore encouraged to now go down to a lower time frame, because you're typically 4-hour M15, that's your simplified approach, but just in the sake of getting a better risk reward for a smaller move, or the same risk reward for a smaller move, does that mean you've had to go down to an M1 or an M5?
Sometimes I'll go down to an M1, but that's typically after a move dictated by like NFP. So post NFP, they tend to be very inducing. We even had PPI yesterday, and it pushed the SP 500 high by X amount of points. And I was like, that low is going to go. It's so inducing. We had a 4-hour gap resting below Asia that had not been mitigated. London continued with PPI, very inducing, lots of volumes to the upside. No liquidity had been taken that day. And I always say, if the 15-minute time frame has not yet taken liquidity, it's going to happen, because it will always take it at least once a day. And if it's induced by news and you want to get involved in, let's say, a counter trend position, which on the SP 500 yesterday it was, because everything was bullish right down to the 1-minute time frame. But if you're looking to hedge that short and trade into a 4-hour area of interest, which is typically what I'll do, I'll either trade into 4-hour zones or away from 4-hour zones. And then you could hedge into that. But if you're waiting for a 15-minute entry, you might not even get a 1-to-1, 1-to-2 if that 15-minute retrace candle, the entry candle, is too large. Or most often, for that reason, if I feel there's a lot of volume entering the market, if it's on New York Open, we get that liquidity sweep that I'm waiting for, then I might get involved 5 minutes earlier than that 15-minute candle close, because then you can increase your risk to reward by an extra 2-to-1.
I see. I want to explore the philosophy of why 4-hour, because a lot of traders, especially newer traders, we're all taught trend is your friend, as you said, but also the higher time frames are more secure because there's more money, it's slow moving, and we're just basically encouraged go to the higher time frames, and therefore everyone just spends like ages on the monthly and then the weekly, then the daily. And if price is just in no man's land, the daily supply is here, daily demand is here, and we're here, well, it's not going to affect today's price action. So I'm in your camp, but I want to explore why you've kind of removed the traditional top-down analysis, working your way down to M15.
Yeah, so for me, my key driver is the 4-hour. I will look at the daily just to have a look if there's any imbalance in price. So if we've had an impulsive day yesterday and it's left a daily gap behind soon after a consolidation, we know that price, especially reaching all-time highs in an S&P market, we know we get those rejections, and it will come back into a draw of liquidity, such as a daily gap or a 4-hour gap. That's when I'll look at that higher time frame, but it's literally seconds and I'm back to that 4-hour. And I just find 4-hour a sweet spot, because it doesn't move too slow that you get bored and impatient, but it also doesn't move too fast that you can't miss things. So it's also really nice to have those two variants of a draw on liquidity on the 4-hour with a fair value gap. So basically a really big impulsive candle with 2 wicks that don't touch either side. It's very, very predictable, especially on Sunday market open. If you get an actual market opening gap, it's like 90% hit rate that price is going to come back that same week to mitigate that gap. And that ends up being a draw on liquidity. But you don't always get market opening gaps where price is not touching each other at all. That's where a lot of volatilities enter the market. Maybe Trump said something or something's happened. But if you could look at those imbalances in price as well, and you tend to have that most days, which is why I look at that 4-hour. The other thing is looking at draw on liquidity with 4-hour swing points, so a high or a low, if you're waiting for price to come and take that, whereas you could be waiting weeks for the same thing on a daily.
Exactly so. Because we've spoken about a very narrow domain, which is 4-hour trend. So let's call it a 4-hour high, low to high, high, and then looking for that to get swept. This could maybe take a couple days or a week to present as that impulse, and then maybe another few days to come back down. And then when it's in your prime territory, looking for that sweep, let's say it doesn't. Let's say it just respects that demand area as opposed to sweeping it. And then the new higher high, which might take another week, you might be sidelined for quite a bit of time because you didn't get the sweep. So will you have alternative setups, for example, trading the demand area, not necessarily the sweep off, or the sweep is the requirement?
Yeah, the sweep is the requirement. That's
Okay.
the key area. So if we have a 4-hour gap and price is just mitigated, we might get a slight reaction, but know that you're probably going to get a secondary run on liquidity on the 15-minute at least. And that's where it's probably best to wait for a change of character on the 15-minute or a market structure shift to turn bullish again. A lot of the time that can happen during Asia anyway, so we're not trading. But if prices come very close to a 4-hour low in a bullish 4-hour swing, the best thing to do is just to wait. And that can instill patience in the market anyway. You could be waiting probably 2 or 3 days maximum, but it's just a really good guide to be really accurate with a daily bias. And a lot of the time, if we're in a consolidation, we just wait for that 4-hour run on liquidity and you'll see the volume kick in, and that's when we get involved again.
What about if price is respecting that demand and then M15 is shifting bullish now? So you know that it's unlikely to now sweep the whole 4-hour low. It's already bounced away. Would you have re-entry opportunities, or is just next time I'll come back to when it's now made a new high?
I'd probably be more inclined to sell into it. So
okay,
yeah, so I really value those 4-hour
Sweeps,
areas.
okay.
Those 4-hour sweeps are really, really keen. It depends on the market as well. Again, everything comes back to what we're trading. Are we trading Forex? Are we trading commodities, indices? So there's a reason why I trade those, because I tested them heavily for a long time and then traded them live for obviously a significant amount of time as well. I've been trading indices nearly 2 years now. And those 4-hour areas are so powerful as a draw on liquidity. Once you've been doing it long enough, you just have that patience to say,
Yes.
if we're mid-range, if we're at the 50% of a 4-hour range, and inside of that 15-minute is consolidating, and you're at the mid-range of that 15-minute consolidation, just go do something else. Just go play golf, right? Don't look at the charts. Just wait. And if it takes the high on the 15-minute, and it looks like an inducing move, I would call, and the 4-hour low has not been tapped into, that's where you could sell into it, and you have a higher probability, versus if you're buying, you're being induced. And then because the 4-hour is more powerful than the 15-minute,
Yes.
you're going to get taken out. Or just wait if you're unsure.
For the last 2 years, a proud sponsor of the show is a top-ranked leading prop firm, Alpha Capital. And for the years that I've been working with them, and the thousands and thousands of viewers, you guys, that have been working with them through the discount codes of Titans of Tomorrow, it's clear for me to see why they are a top-ranked prop firm in the industry. They have also reached a monumental milestone of $100 million in payouts. And with the multiple step plans and the multiple package types they have, there's going to be an option catered specifically for what you're looking for. So you can buy an evaluation account catered to your needs at the most competitive prices, and with our discount code TOT for Titans of Tomorrow, you're able to get the most unbeatable, unmatched prices in the industry with a leading trusted prop firm. And with that being said, let's get back to the episode. I want to explore this idea of, just because recently I've had a lot of veterans, let's call it, these guys that are 20, 30, 40 years of market experience, and some of them are part of the Society of Technical Analysts. So these are, really professional at technicals. But when I explore it with them, it boils down to baby pips. It's like really primitive, old school technicals of just support and resistance, trend line, Fibonacci, and an RSI. And if you were to now, if I put them here with you and you were talking about sweeps and this liquidity and fair value gap or gaps, it would be a different language. You're speaking my language. I'm with you in this camp, and I struggle to have conversations with this camp. But explore to me this concept of liquidity, because I know a lot of the viewers will still be in that other camp of just head and shoulder patterns and overall trend. And here we are targeting supply and demand zones. We're targeting market structure. We're looking for the sweep and the failure of probably their stop losses. Explore to me why that is your philosophy.
Yeah. So there's a big contradiction in liquidity as a term in itself in trading. Some people believe in liquidity and some people call it volume, and it's just down to what works for you at the end of the day. I'm not saying that what I'm saying is right. I'm just saying it's worked for me. And so if we look at supply and demand, if it's an area that's not taken higher time frame liquidity. So again, if we're in a bullish trend on the SP 500 and prices come back to a 4-hour supply but has not taken any liquidity, I'd see that low as a trap, like a retail trap. There's no inducement involved in that. And I'd look at that on a 4-hour, interestingly, the exact same way as a 15-minute bullish move on news, like NFP. The origin of NFP, it will get ran the same day or the next day, 80, 90% of the time. We see that happen again on a 4-hour, but just takes a longer time if it's not had any liquidity. Sometimes you'll get an internal range structure liquidity sweep instead of an external range. But the market's not perfect at the end of the day. I like to class the market the similar way as a surfer going out into the ocean, right? The surfer is skilled, is knowledgeable, usually experienced. They're going into the same water every single time, and they're going to repeat the same practices. It's their strategy, you could call it. But they don't know how big or fast or long the waves are going to last. And that's the way I look at it. So we've still got to adopt the same technicals onto the market, but you've also got to look at the nature of the market. So
nice analogy. I like that.
Yeah. So if you're expecting price to come into a 4-hour gap or a 4-hour low and react with a wick, or the next 4-hour candle immediately is a bullish retrace candle, it's highly likely a liquidity sweep, in my opinion. Then I'd be more likely that same day or the next day to start trading continuations off the 15-minute with my entry model. However, if that blasts straight through with a really heavy bearish candle, we know that the nature of price is that it's probably going to draw lower into another liquidity pool. That's when I drop out to a daily time frame, look left. Is there something very close by, like a daily low perhaps, where now on the 4-hour we're seeing a momentum shift to the downside temporarily because I'm trading indices. We know that over time it's going to shift back bullish again. So it's having that mindset of, okay, what's likely to happen here? We're not trading euro dollar that could be bearish for 4 months. It's probably going to be bearish for 4 weeks. So it's looking at maybe a daily low and then marking that, waiting for the 4-hour to tap that, then looking at price, how it reacts to that area. Being more aggressive, knowing that if you can buy the S&P 500 at a lower price, you're going to have much more risk to rewards to the upside, especially trading a swing account.
Yes. I want to explore qualifying points of interest. So if we talk about the 4-hour low that made the 4-hour high, obviously that's left a demand area. So in that, let's call it an ordinary market structure point where it's just trended lower and then started to have the breakup structure and trended higher. So ordinarily lower lows, lower highs, and then higher lows, higher highs. Simple market structure. So you're waiting for that to get induced. It makes sense to me. What about in the scenario where the entry you've got in, which is you've swept the 4-hour low and then that's gone on to make a new higher high. So now this one is not just a demand area that made a high, it's a demand area that swept a previous low. Would this now be a weaker zone for you to induce next time? Or is this equally traded? Basically to say ordinary points of interest versus inducement related points of interest, do you differentiate them on a higher time frame?
Yeah, so I have a technical way of looking at that. So I'll use a rectangle box on a recent 4-hour dealing range.
Okay.
So you'd have your highest point, you'd mark a rectangle down to that last swing 4-hour low.
Okay.
And I would only class that as a shift in trend if we have 2 lower lows beyond that. So even if that lower swept recently, price creates another higher high. If price comes back down to that low again just once, I'd still treat that equally as a sweep of liquidity, because you can see that we have secondary runs in on a 4-hour time frame, which is really just one running on a daily, especially in indices, because again, we know that overall it's a bullish market. So how bearish can it really be? Even when we saw the introduction of Trump's tariffs, it dropped significantly, but we were bearish anyway, according to bearish ranges. It had printed like 4 or 5 lower lows on the 4-hour on the SP 500 before, was it April the 6th or something, introduced the tariffs, and then it dropped 200 points. But we were already selling for 2 months beforehand. So it wasn't a shock to us. It was a shock to the mainstream media because they're fear-mongering, but we were already bearish. And then we wait for it to hit a higher time frame level of liquidity. The tariffs ended up taking a weekly low, and then a 4-hour was an internal 4-hour structure shift because the move was 200 points. You couldn't get an external range sweep, and it was internal playing all the way on the way up, filling the 4-hour and daily gaps along the way.
Would you say it's correct for me to say that news is a catalyst for technicals, or would you say that news is the driver of price?
I would say it's more a catalyst, because more often than not, it will move in the area that liquidity is resting, or it will take liquidity and move in the intended direction of the overall trend anyway.
If you could speculate, because I guess no one really knows, why is it like that? what you may see on a lower time frame in technicals, in essence, be able to predict what the news release may be. And it's something I've seen a million times also, but I can't put my finger on why it would be like that.
Yeah, I think that's just a matter of opinion. We don't know who really is driving the markets. It certainly isn't me and you. I wish it was, but we're not trading that kind of level of capital. But I guess it's all about risk, right? The traders that are the veterans, those that have been trading the longest, they will always put risk first before profit. Whereas the beginner traders, they're trying to make the profit and they're almost like forgetting about the risk, which is why they lose so much. You know, the gamblers, for example. So if someone's got 10 million to put on a position on the SP 500 and the market is already bullish, doesn't it make sense for them to collect some liquidity below a nearby low and then continue that trend? The trend is your friend. The trend is everyone's friend, right? If the market's been bullish for 10 years, why would you bet against it?
Yep.
And I think it's more about protecting risk and capital than anything else.
Now that we've kind of understood the framework of what generates an idea for you, I want to explore now execution, specifically when you are in a portion of a sweep. So you have a higher low that made a higher high, you've come back all the way down, and now you're breaking past it to sweep it. But from a market structure perspective, you've actually made a lower low. The previous higher low that made the higher high is now lower than that, so you've now formed a lower low. So at the point where the market is now forming a lower low, you're actually looking to counter that and say, no, this is an inducement or a sweep, and I'm looking to buy. How do you differentiate between what is a bearish switch and we're going to continue lower versus, no, this is a sweep, we're going to continue higher? It's an inflection point, basically. How do you know which one is which?
That's, again, down to the 4-hour dealing range. So if we're in a bullish market, we have a dealing range which is bullish. So draw a rectangle on the highest point, trail it back to the nearest 4-hour low. If price has broken that low once, class it as a sweep. And don't class it technically as a breaker structure until that low, the price takes away from it and then creates another new low on the 4-hour, not on any other time frame. Because if you get a new lower low on a 15-minute, that's just an extension of the same 4-hour sweep. So you could get a sweep that lasts for 3 4-hour candles.
Yeah, it doesn't have to be the first strike. It can accumulate around that, yes.
Let it accumulate for a day or two. And if your 15-minute entry model sets up, keep buying because the higher time frame trend is still on your side. And if it takes then a few days later and takes another 4-hour low, you can assume temporarily in indices market that you're going to shift lower.
Okay. Would this philosophy apply to other markets, or is this specifically a tendency you notice in indices because they are an appreciating asset?
It was the same way I was trading with Forex. It's just you don't have the volume there. The volatility is not as high in the Forex market as in the indices market. And also,
what do you mean by that in terms of volume?
Just in terms of how much trading volume's in the market. I just found that if you're looking for a bullish move, it's just not going to ride as long, and you just take significant amount, in my experience, significant more amounts of break evens before you got the move. Again, it comes down to what's more reliable and predictable for me. And I basically took out my strategy from trading Euro US dollar and didn't change a single thing and put it into the German DAX and the SP 500. And all of a sudden saw a massive increase in my reliability just because I knew overall, what am I trading? What's the nature of the beast? With Forex, you don't really know. It could move sideways for 3 months and then be bullish for a week and then automatically shift on a 4-hour, become bearish for 2 weeks. And every time I was shifting on the 4-hour, I'm having to sit on my hands, and I got fed up of waiting. I thought, my edge will play out in time, but at the same time, you've got to make money, right? You want to make money. So moving it into a market which is more reliable and tends to be more volume. I may not know the technical reasons why, probably more trading volume in that, more money involved in indice market. But I just found that reliability is such a key factor. In fact, every single time the 4-hour on an indice such as NQES starts to shift bearish, the first thing I'm telling myself and my traders is, this is not going to last a long time. So be aware on the 4-hour time frame and on the daily time frame, where is the nearest higher time frame liquidity pool? That is the turning point. And then I call it the golden zone. So let's say we have a bullish market like the SP 500. 4 hours broken the nearby 4-hour low. We're expecting that to be a liquidity sweep. But the next 2 days it consolidates, then it breaks a new low. We're now bearish on the 4-hour, but we're still bullish on the weekly and the daily. And it's a bullish index. So if we then trade lower for maybe a week or so, and then we see a 4-hour shift in the opposing direction, which is either it runs into a daily low and we just get one single break on the 4 hour, I class that as a market structure shift and I'm ready to buy.
Okay.
If there's no daily draw on liquidity nearby, I'd need to wait for 2 higher highs on the 4 hours confirmation.
An internal bullish range. Okay.
Yeah, exactly. And I call that the golden zone, strictly speaking, because I've got confirmation of a change of trend, which is now in alignment with the higher time frame and a bullish index. And the icing on the cake is the fact that I can trade from here and I have a visible target.
Yes.
And I'd much rather trade that than in all-time highs, because we know that SP 500 or gold, it can trade into all-time highs for 20, 30 points and then completely retrace back into the range again.
When we're speaking about this specific scenario, I know it's hard to follow because we're using just words, but when you've had a 4 hour internal bullish trend, I guess 2 legs of bullish structure, and now we come back to that previous high low in that internal range, are you once again waiting for the sweep of, or now because it's an internal range, you just buy
only on the 15-minute? I'm only waiting for session-based high or lows to occur. So if we're bearish on the 4 hour, we run into a daily low and we get one new higher high internally on a 4 hour, and then waiting for either the same day that that's happened or the next day for London to take Asia lows to buy, or New York to take London or Asia lows in the process and buy there, and I'll target the all-time high or the nearest 4 hour high.
Okay. Aside, because we're talking about liquidity sweeps, aside from a market structure or demand area sweep, what other pools of liquidity are relevant to you? Because we can draw infinite potential pools, not only for the entry or directional bias, but also you're talking about exit points or where you're targeting in terms of not just all-time highs, but previous liquidity pools. What is liquidity pools that you are focusing on?
Liquidity for me, in simple terms, higher time frame is the most recent daily gap. So if yesterday was very impulsive, especially after a news release like NFP, FOMC, core CPI, retail sales, and it leaves a big gap, then I'll look at targeting that or waiting for that to then trade away from. Same exact concept on the 4 hour. So if we're creating higher highs and higher lows on the 4 hour, if there is a gap resting underneath a 4 hour low, I'll wait for that price to at least mitigate that. It's like a double confirmation. It's taken a 4 hour low. It's also mitigated a gap. You could call it a fair value gap. I like to just see it as imbalance or inefficiency in price. We know that price likes to become efficient, and if there is a gap nearby, it tends to come back and target that. And that could be used as an entry point, as long as you've got your lower time frame entry model within that, but also as an exit point as well. It's different if you're trading futures, only because you've got those two things to be aware of. One, you have to close your position by the end of the trading day. So you can't just say, I'm going to target the 4 hour high and go to sleep. Well, you'll be liquidated and you have to go through your evaluation stage again. And then depending on which firm you're using, through experience, it becomes really tough when you've got that trailing drawdown. So you can no longer then, from a target point of view, a profit taking point of view, say, right, I'm in the golden zone, this is great, I can hold this for 3 days. No, you've just got to target 2 to 1 and be out, otherwise you lose the account. So it's a very different risk and trade management approach.
I spoke to a chap a few days ago, and he had a recent transition like yourself of, he was trading in the CFD side, specifically in Forex pairs, and then he went to futures for probably a similar reason that you wanted to, just to scale up and test himself. We didn't discuss it on camera because he wasn't ready to talk about futures yet, but off camera we explored it, and he said that fair value gap or gap inefficiency, whatever, is not something he focused on or paid too much attention to in Forex, but he said it's basically become his key thing in futures or in indexes. Is this something you've noticed, where fair value gaps or gaps are something a little bit more important in the futures?
I would not say I've actually noticed a difference between the two feeds, but I am definitely, as a trader myself, and I'm always evolving. I'm not sure on what your take on this is, but me, even 1 or 2 years ago, I trade slightly different now. Like the key structure is still there. 4 hour key driver, 4 hour trend, 4 hour dealing range, liquidity trend, 15-minute for entry, session based, external range liquidity holds more favor over internal range liquidity. That's been the same for 4 years. But then I'm looking at things like, okay, nature of price when it breaks an all-time high, I might want to trade against the trend and trade into a 4 hour fair value gap. That is something that I am now starting to look at more. 6-12 months ago, it was more, we'll wait 2 or 3 weeks for a market opening gap come Sunday open, and then I'm going to trade into that. But then it'd be like, well, we don't get that for like 2 to 3 weeks. Then what? We're just targeting 4-hour highs and lows. And that's fine. There's plenty of opportunity in the market. We don't need it all 2 or 3% a month. And you're laughing with a decent amount of capital. But then I've started to notice in my own trading this last probably 8 weeks or so, just the value of a daily and especially a 4-hour inefficiency in price as a draw on liquidity. It's just huge. And for an awful long time, I would say if I'm looking at the London session for today and the New York session for today, that's all I really care about. I'm not interested in what's probably going to happen tomorrow. I'm not interested in forecasting on a Sunday for the rest of the week.
Then. Yes.
Which I used to do for years. I was taught that way for a number of years. Like, have a watch list of 18 crosses and then draw all over your chart. And then by Monday morning, it's like in the bin because the market gapped down or something. It's like, oh, I've got to do it all over again. It took me 3 hours to analyze on a Sunday. So I don't do that anymore. I spend like 5-10 minutes in the morning looking at what's happened overnight, which typically on a 4-hour is not an awful lot. I look at a draw on liquidity, like a fair value gap or imbalance in price on the 4-hour, and look at structure, look at trend across my crosses. What's consolidating, I'll toggle off. What's trending and clean and has a clear higher time frame draw on liquidity, I'll keep on. And that's what I'll trade during my kind of kill zone, which typically is New York Open for about 60 to 90 minutes.
Just the last section I want to explore on this sweep, which is a key pillar of your entire strategy. Sweeps can be just kind of a few pips or a few points, and it just shoots 10 pips lower and then reverses. Other times you'll see it sweeps into something, as you're mentioning. It sweeps into a gap closure or into a lower time frame internal structure on the previous high. It taps into something that you'd expect it to, whether it's basically a demand level or order block or a gap. Other times it seems unsuspecting. It just sweeps and goes. Is it for you a requirement that the sweep has to land into something? For example, sweep into a gap, or it just has to be a sweep?
It has to either sweep into a 4-hour low or a gap. If it just sweeps into anything, then it's just noise on the lower time frame.
That's an important differentiation. Okay.
Yeah.
And now moving on towards the execution. So I think it's pretty clear to follow the framework of the idea generation. How do we go from this is an idea that I can take, perfect, A+ setup, versus almost there but not valid for me?
Yeah, we've spoken a lot about that higher time frame and looking at choosing what kind of market to trade, the structure of it, whether we're trading into, in a bullish 4-hour market, a fair value gap or into a 4-hour low, or whether we are targeting that and actually taking a counter higher time frame move and selling into it. The actual entry model itself is one that a lot of people trade. They just call it different things. I much prefer to trade just off the 15-minute because I'll take typically maybe 3 or 4 trades a week versus taking 2 or 3 trades a day on a 1-minute time frame, depending on the trader, right? And there's just an awful less amount of noise. And if you're looking at a buy position, for example, Asia will consolidate a lot of the time because of the lack of volume. And if you're looking for a buy, because of your 4-hour bias, not because of anything else, because your 4-hour bias is what gives you your direction for the day, in my opinion. And then if London continues without taking any liquidity, we know that New York is likely going to come back and take Asia lows. I'll also look at the initial balance. And this is something that I've been actually trading for about 8 months now, where the first hour of Asia, there's 2 ways that you can look at this. So if you have a bullish bias anyway, and after the first hour of Asia price starts to trade above, that's like a confirmation. Okay, the price is heading in the direction that I want to trade, even if it's in 5 hours time, because New York's not open yet. But then when price comes back to mitigate that first hour, that initial balance of Asia, and
which happens to be Asia low.
Yeah.
Got it. Okay.
Yeah, just that first 60 minutes of Asia. So from midnight till 1 a.m., right?
Okay, got it. Yes.
So if it trades back into that zone and happens to take a session-based liquidity, so if London takes Asia low, you can take a trade in London. Or if London's continued without taking liquidity in Asia, wait for New York, and New York will typically take either London or both and mitigate or liquidate the initial balance. It's like a double-edged confirmation in terms of 50-minute liquidity. You wait for your retrace candle, make sure that's between 2:30, 4:30 UK time, or was that 9:30 till 12:30 Eastern Standard Time, and then you're targeting a minimum 2 to 1, ideally.
So it's not necessarily following the internal trend post or let's say London Open, it's not just following that, it's waiting for that initial trend to present and then waiting for that sweep once again. So in all of your setups, you'll have a higher time frame sweep and then an M15 related sweep. So it's a double support in that sense.
Yeah.
And the entry itself is just waiting for, I'll let you describe it. What is the exact execution point once you've seen these characteristics?
It's very simply waiting for a bullish 15-minute candle closure if you're looking for a buy. And that has to be the sweeping candle, and it has to be inside the kill zone.
Okay, and that bullish closing candle, do you look at the prior candle? For example, does it need to engulf the prior candle, or is it just a bullish close after the sweep inside the kill zone?
If it engulfs the previous candle, it's a sign of volume, so
Yes.
I prefer that.
Okay.
The only thing with that is sometimes that candle become quite large, and then you're like, well, I can only get like a one-to-one, so I'm probably going to leave that. That's a filtering process for me.
That was actually going to be my next question of because you're an M15, I'm following very similar principles to you overall in my analysis. I'll just take it down to an M5 or M1 to get that final entry point. The reason being is because M15, whatever happens on M1 will transgress into M15, but the difference I would see is that sometimes I might get a doji candle, so my M15 might be, are you covering the wick low or the body low?
In futures, I'm tighter with my stop right below the entry candle. If I'm taking a swing position, I'll look left. Is there something else I can cover?
Okay.
Because I don't want to be taken out like overnight if I'm going to hold this for a matter of days.
Okay, regardless, you have, let's say, a doji candle which might be this big, and that becomes your stop loss size and therefore the risk reward potential. Or if you get a large engulfing where you just got a larger stop loss and then the risk reward question thing you just mentioned now. So how do you, which is not such a problem, or the range of potential stop loss sizes is narrower when you're trading an M5 or M1 execution. Why choose to still be on an M15 and have that variance? And how do you decide setup is good, entry is good, risk reward is not worth it? What are the cutoff points on either end?
Just candle size, and then if I have a set target, let's say if New York has swept the low and that's my entry and the 15-minute candle's quite large, and I've already predetermined when I'm going to exit. If I'm trading futures, it's going to be New York highs, because it's going to take 2 or 3 hours to get there, and I'll have to close the position by then anyway.
Yes.
My hands are tied, and a lot of the time I'll close it, and then the next day it's continued like another 3%, but you can't do anything about that. That's the beauty of a CFD swing account or a personal account, and that's the drawdown to futures. But it swings and roundabouts, right?
Yes.
But yeah, it happens. It happened this week where the SP 500 followed my exact outlook from like 6 hours earlier. But I said to my guys, I'm not taking this because the 15-minute candle's just too big. And I left 2-1 on the table, but I was happy with that because I predetermined it.
So is it a cutoff based on, I'm basically trying to understand the objectivity of it. Is it a cutoff based on points or size of the M15 candle that you're entering upon? Or is it a relationship between whatever that size is plus the target, and then a minimum risk reward has to present?
It's all about the risk to reward.
Okay, so what's your
minimum? The question
minimum?
I get a lot is, how do you determine your stop loss size? And I say, well, it's the risk to reward that determines the stop loss size.
Oh, what do you mean by that?
So like if you get a 15-minute retrace candle, bullish candle, you're looking for a buy, you put your risk to reward tool on there, you've already predetermined your take profit, which on a swing could be a 4-hour high, or it could be just the highs of the day or the New York high. If you can only get like a 1.2 to 1, well, what are you going to do with your stop loss? Are you going to stop crop it? Which I will do after a news release. Have you heard of stop cropping?
It sounds like you're maneuvering your stop loss based on what the risk reward you want, as opposed to a objective, predetermined invalidation point.
Yeah, so if you get like an NFP, for example, hypothetically speaking, that runs into the area of liquidity that you want to trade in, and then 30 minutes later New York opens, but the NFP candle has quite a large tail wick.
Okay.
You place your stop loss inside of that wick, not cover the whole thing.
Why?
Because if it's an inducing move, we call it, especially if it's fundamentally driven, and the technicals align with what that news release has liquefied or liquidated,
Yes.
we know that low, some people will call it protected low. It's not likely going to come that low. And if I am going to be able to get an extra 2-1 out of that position, great. If I'm wrong on the trade idea, I'm still only going to lose 1%. So I may as well stop crop it. And I'll only do that within like an hour after a news release. But typically you don't get those large wicks. So I just cover below that candle. And then my risk to reward will determine my stop loss size or whether I'll take the trade or not. Typically like a 1.5 to 1 on futures, but
Okay.
2 to 1 minimum on CFD.
I've spoken to a variety of guests on the show, and a unanimous common denominator between all of them is the emphasis they put on data and actually knowing the inner workings and the insights of your edge and your performance. That's why I'm proud to bring a partner of the show, TradeZeller, the #1 journaling, backtesting, and all-in-one insights experience created by traders for traders. What TradeZeller really gives you is deep insights about your trading that would ordinarily not be visible, whether it's through understanding your trade types and playbooks, or even insights powered by artificial intelligence through Zeller AI. Whether you trade Forex, futures, cryptos, the stock market, it all seamlessly connects to TradeZeller, so there is no additional work. You've seen me reference it dozens of times and all of the benefits I've had in my trading from the insights I found from my TradeZeller. So join myself and thousands of other viewers of the show. You'll get the best discount using the link in the description or code TOT for Titans of Tomorrow. Just exploring this because I haven't heard it before, but I can see the wisdom behind it. But you'll have just probabilities of sometimes it has that protected low. It's a impactful sweep and price never comes back, and that's when I wouldn't even get in the trade because I'm waiting for an M1 or M5 entry model, and you're just like M15 candle closure, get in because it's ready to take off, which it should after such a sweep. But then on other times you will see it come back all the way to like basically that protected low, 2 pips shy, and then go on to make the new high. And both examples do exist, probably like a bell curve, I guess. At what point when you are cropping the stop loss, are you looking at M1 as some sort of M1 protected low, or is it just 50% of the wick? How do you find clarity in how to crop the stop?
That's all down to the entry candle list again. So if we use that particular example, let's say you've had a news release that's created 1 or 2 very large bearish candles that have run into a 4-hour low or a 4-hour gap inside, well, usually that's around 1:30 UK time. So I'm not trading for another hour.
Okay, yes.
So you've got 2 to 3 15-minute candles after that, which usually are very small, because like the volume of the news release has occurred in that big candle. Then there tends to be a kind of a dry down or a lack of commitment after that, which is also, for me, nature of price, I call it. This could be a sign of a reversal, because if that news release had pushed into the intended direction of the trend, it would have continued for another 3, 4, 5 bearish full volume candles. But it was one candle, then it stopped, and tends to have a tail wick. So then I'm not getting involved for another 2 to 3 15-minute candles anyway. And if the 15-minute candle of New York Open is the first one I have, I've got an idea in mind of a trade I took about 3 weeks ago. I'll just put my stop below that candle, the entry candle. So if you've got a wick over here, which is the news, and the entry candle is here, you're cropping the news wick, but not the wick of the candle you're entering from.
Interesting. And what is your philosophy now on trade management specifically? I guess you have a hard target predetermined, no partials in between?
No.
Okay, and will you leave a runner? I guess in futures not an option, but in general, is it, explore to me, is it just hard TP level, or is there any other scenarios that you might explore in different cases?
So there's 3 management strategies in terms of how to manage a trade that's running. First of all, we'll cover futures, because again, depending on the futures firm that you've got different cutoff times. Some of them you've got to close the trade by the end of the trading day, the actual end of the trading day. Some is a few hours earlier, or you're penalized. So you've got to lock in that profit. If you've got trailing drawdown, you want to move your stop to break even, maybe into profit much sooner, because you can easily, even on a 15-minute, have a trade run 1-to-1, come all the way back to your entry point. You've already lost like $1,000 in drawdown. You've only got $500 left. And even if that trade then goes and hits your TP, you could be taken out. So sometimes, it's wild. Sometimes I'll just cut it short because I'm not liking how reactive and how aggressive a retrace is. So that's again one of the downsides to it. If I'm trading a CFD firm and I'm looking at targeting a 4-hour, let's say an internal 4-hour structure, which means you've got an all-time high up here, you've had a bearish move and you're buying from here, I would then just target, I would move my stops to break even above 2-to-1, but then I would just have a hard TP and I won't lock in anything. So I might take a few more break evens in that scenario, but usually if I'm right, based on higher time frame liquidity and timing, you can ride a good 4-5-to-1.
That covers the break evens basically.
Yeah. If I'm external range, so in all-time high, that's when I'd trail my 15-minute below every 15-minute swing, because if you are external range trading in a bullish index, in a bullish market, all-time highs, that could last a day and come straight back into the range, fair enough. But if it continues, it can continue for 2-3 weeks. And instead of just having a hard TP at a 3-to-1, you could lock in a 6-7-to-1. It happens less often, but in that scenario, I would trail my 15-minute stop loss.
I want to explore the specifically the futures firms, because now I'm thinking you might have a 1 to 2 risk reward predetermined, and it plays out. But because of the trailing, the type of retracement, you can run into problems. So you have to now factor in what kind of a reaction I get after my entry, because if it goes direct, easy days. But then if it's now just creating a healthy internal price action bullish, at some point it might go too much into trailing drawdown. And let's say, I have to cut it because of the price action you're getting after the entry. You might now, a winning trade that could have been a 1 to 2, you got cut out at 1 to 1 for the rules that you have. Does that now spill over into just your whole edge is now all over the place, and the win rate that you have is supported by the risk reward you often get? But now if your risk reward is cropped, that win rate maybe no longer supports, like you enter a lot of problems, domino effect. How do you navigate all of these things specifically with futures firms?
Yeah, so in my experience with trading futures, there's definitely some drawdowns in terms of, there's definitely heightened anxiety around if you've got trailing drawdown. But there are futures firms that have an end of day balance, which is much more favorable. And I'm looking into those as well. Because that's more in alignment with how I would trade anyway. I'm not the kind of guy to scalp, and I won't want to take 1-to-1s, because then you've got to have an incredible risk win rate, right? Yeah. So that will just eat into your anxiety. Mm-hmm. And I think with trading, I've been trading for 10 years, nearly 11 years now. And one of the biggest things is how can I reduce, first of all, my screen time and not be here for very long and do other things? And 2, how can I reduce my anxiety? So either trade a smaller position size, have a larger risk to reward, so you're not having to have as much of a bigger win rate. So yeah, trying to avoid the futures prop firms that have a trailing drawdown, especially for beginners, I think is healthy, because if you're, it's going to eat into your results long term.
Exploring this word of anxiety, and a very well documented thing that many guests have spoken about, including yourself, which you are doing now, is have other source of income, or have other things going on, have a life outside the markets. All of these things will support you in your trading, because the more outcome you chase in the markets, the harder it becomes. Your emotions get amplified if you need it to pay rent. And if you're obsessed with the markets, you're in front of the screen 24 hours, you're going to take erratic and irrational decisions just by being human. I want to go back to the time when COVID hit, and you had the opposite of what you have now and what others preach, which is your back is against the wall and you had no other option, and you had bills to pay for. How did you navigate trading and also the emotions of trading with the situation you were in?
Yeah, so I think it was a matter of timing as well as just impact and what had happened. It was quite a pivotal moment in my professional career, where I was around 5 to 6 years into my trading journey, and I was probably more a hobbyist. I wasn't really taking it all that seriously. But that's because the focus that I had was on the small fitness business that I had. And I was running that for, at the time, about 8 years in. And that was paying all the bills. I wanted more out of life. I'm very entrepreneurial, which tends to be those people that aren't very academic, tend to be more grafters. And I'm definitely one of those. Didn't want to be like the family letdown. I kind of already knew I was because I didn't go to university like my brother did.
Okay.
I didn't follow in the footsteps. I was very much D grade student. I got a brother that's A-star everything. Everything he touches is gold.
And you're a younger brother.
I was always in the shadow. Yeah, I'm the younger brother as
That's
well.
tough.
So it's like, well, when are you going to do something? And so I was like, well, I'm going to take risks. Oh, that's even worse. So I had a lot of outside pressure involved. And to have a fitness business rug pulled because of COVID, being told to close, when the supermarket's open and you can rub shoulders with 1,000 people, where a gym that could be on a timer, 5 people per hour, and you could have 10, I could have done social distancing, 10 meters per person. I had a big unit. Nope, not allowed to open. And if
crazy.
gyms were opening, you get a £20,000 fine. And if you were doing that.
Oh, wow, that's brutal.
Yeah, it's crazy.
And more importantly, you had rent to still pay. You still had your costs, staffing and so forth, but no members or reduced members. That's,
Yeah, so we didn't really know what was going on at the time. No one really did. It was like, there's this thing called COVID and we're going to have to shut down. We're going to go on lockdown. And I was saying to my staff, well, this will probably only last a couple of weeks and it'll blow over. Don't worry about it. I was always the optimist. And one thing I said to my team, I was employing 10 people at the time. I said, whatever happens, I'm going to continue to pay you. A few of them left because they saw opportunity in online coaching, and I respect that. I was probably a bit annoyed at the time because a lot of my customers followed them. But I did have a really loyal fan base, membership base that would support me. I went from 700 members down to about 150 paying members, but my overheads, like you say, were exactly the same. To make matters worse, I'd just come to the end of a 10-year lease on the building. So I was
he
put
wanted to
under
increase.
pressure to not only, a price increase as well. It's only upwards. So I was paying an additional £1,000 a month going
That's a
forward.
lot. Wow.
And that was during first lockdown, when we didn't know when we were coming out of lockdown. Business was hemorrhaging money at that point, dipping into savings to survive. And I had to enter another 10-year lease in uncertainty. I was like, well, my back's against the wall here. Plus, my partner had just given birth to our third child. So we had a baby at home. Yeah. We had two of the children off school because schools are closed. And I'm at the gym working 12 hours a day for no profit. So I was like, well, I'm going to have to take care of my business first so I can pay the bills, so I can look after my family. But my back's against the wall. So I was getting up at like 5 a.m, back testing for 2 hours, then going to the gym, working at the gym, trying to trade the London, New York session, probably forcing a lot of the time, but really like trying to stay as disciplined as possible. And then at the end of the day, putting the kids to bed, more back testing till like midnight. And that was causing a lot of friction in the house as well. Like my partner was like, when are you going to spend some time with me? And I'm like, well, we don't want to lose the house. We don't know what's going to happen. So it was definitely a case of my back was against the wall. I had to make it happen. But it was also lucky in my case because I was already a break-even trader. If that had happened 3-4 years earlier, I don't think it would have worked because I was too early in my stage. I was still finding my feet. Whereas I had strategy, I just needed to focus on it. And it was a transition from being a gym owner that sometimes traded to then a trader that also happens to have a gym. And it was that mindset shift and the fact that I put trading first that really pushed things forward. And I always had mentors. Some were good and some not so good, but I put them as part of my journey. I had mentors in my fitness business as well. And I always feel like having someone that's doing better than you in whatever space you're in, you're going to benefit. Just like I had personal trainers helping people to lose weight. The people that didn't have personal trainers, 99% of them, they never lost any weight. Yep. They looked the same, even if they would come in 5 times a week. They would never look any different. So it's about timing for me. And going from break-even trader to actually starting to make money, and it opened my eyes. And I was having to then think, right, do I want to go all in on trading? And it basically made me feel like I'm not even in control of this business myself because the government can just turn it off.
Yeah, I agree.
So I was like, I now have very little faith in this kind of small business model that I'd ran at that stage for 10 years. That 2-year period of in and out of lockdown, hemorrhaging money, it was terrible, but I was looking to find a buyer to exit. And I'm very fortunate that I found someone to buy it rather than just closing it down because it had potential. We had track record. It was a very thriving business, not at the time that I sold it. So that's why I'm saying I'm lucky I sold it rather than handing it over. But they saw that potential and I actually sold it to the world's largest fitness franchise.
Oh, nice. Cool.
So and that's still open today. It's thriving.
And I guess this that amount that you sold it for, was this just to pay off the hemorrhaging situation or deferred salaries and so forth? Or was this now a relief pot that is like, okay, now the house situation and kids and all of this is now calm and alleviated some stress in your trading?
Yeah, it definitely wasn't an amount to retire on, that's for sure. But it paid off any business debt that I had to do as part of that transaction anyway. I had to clear all of the business debt. And there wasn't much of it, luckily, because we'd run a very safe ship, for that amount of time. But there was a small amount of debt in lockdowns that we just dug into. Yes. In fact, for 10 years, I never had a business overdraft until COVID hit. And I'm like, can I have an overdraft? Because I don't know what's going to happen. So we paid that off. Plus we have some, obviously, tax to pay on that, paying legal fees, accountancy fees. There wasn't much left, but it left some pot to be able to live on while then I was producing income from my trading. And that's where things really accelerated.
Yeah, I think that's an interesting concept of just if a lot of people talk about before you go from whatever 9 to 5 you may have to full-time trading, you have to have this safety pot of X amount of months of run rates. Typically, or in your situation, what is that healthy amount of run rate to give yourself where if you say like 2 years run rate, well, it might take forever to get to that point versus if you do it too short, it's too much stress.
I would say 2 years, about 2.5, 3 years is what I had as a pot.
Okay, you had ample time to figure it out. Okay.
I did, but I also had 3 mouths to feed.
Yes.
So if you've got to look at your situation. If you live on your own and you're with your mum and dad, you probably don't need a pot at all. You just need very supportive family. Maybe give them $100 a month to keep you there. Pay for your own food or something like that. But when you've got a mortgage, you've got 3 children, you've got utilities, insurances, food, bills. It's a big responsibility, right? And we also used some of that money to invest in a property because we actually moved house at the same time.
Oh, everything at once, man.
So we sold the business.
Okay.
I went all in on trading. We moved house. We bought a house that had not been lived in for 3 years. We gutted it. We completely renovated the house from top to bottom.
During lockdown or around that time?
Just after lockdown,
Okay.
2022. We had a baby, so we had 3 children at that stage. But we had long-term vision. We're like, this house is going to pay for itself with one hire a month. And we're now hiring 1 or 2 days a week on average throughout the year.
What does that mean? Like as an Airbnb or?
No, like household brands will come in and use it as a shoot. So most websites, like household
Yeah, you
names
do have a
that you'll
beautiful
know.
house. Okay, yeah. So it's
So
for photo shoots
you'll
and
notice,
stuff.
oh, there's our fireplace. There's our bedroom on a website or sometimes on a
amazing.
television advert. And
Okay.
you'll just kind of notice that it's ours. And it's a great business to have because you only need a few. It's difficult because you got to keep the house immaculate. But we're like that anyway. Especially with 4 children, you leave it for 30 minutes and it's a mess. But
Yeah.
if you keep it tidy, we have to move out. Of course, there's costs associated. So we'll either move in with family or an Airbnb. We kind of have a bit of a holiday. I continue to work because I can work wherever my laptop is.
Yes.
And then we'll come back a few days later. And that's partly what my business does. She's a content creator. She's almost like a brand designer. She rents the house out, and now she has her own furniture
I
brand.
see
off
what
the
you
back
mean
of
by
that.
turning your house into an asset that you live in, which
Yeah.
ordinarily it isn't because it's not yielding anything. That's beautiful. I want to speak about your prop firm journey specifically this year. So you've obviously, in the CFD side, not necessarily the futures one yet. You've taken on a challenge for relatability to people that are watching, but also I know financially it's not something you can ignore. 250K in a year is very significant. Walk me through that journey to go from, let's say, your first couple of evals to now, a year later or whatever, with multiple 6 figures in payouts. What did you have to go through and learn, and maybe certain insights?
Yeah, so I kind of saw it also as a test, because it is a test, right? It's not easy to pass an evaluation. If you are looking at a CFD firm, they're usually 2 phases, typically 8 to 10% profit target on the first one, and then 5 to 8% on a second phase. And one of the first firms I used was FundedNext. It's a 2 phase. Then I eventually moved into the Stellar 1 step, which I believe is around 10%, just 1 phase. And that was great. So taking like 2 or 3K payout from a 50K account, so you're looking at 4 to 6% on a payout is very good, and then reinvest some of that into more challenges. And it got into the stage where I'd buy 2 challenges and I'd alternate it. So I'd either trade the same asset and alternate trades per account, because one will do better and take the wins, and one will do not as good and go into drawdown. So I'm just utilizing prop firm accounts as tools. I'm not putting it on a pedestal. And it's something that I did way back in my early journey, and I see a lot of traders still doing it now. And I understand, because sometimes it can be a lot of money. But if you buy one prop firm account, it's like you really don't want to lose it, because it's like, this is like make it or break it, this one account. And they could go 3 months on a challenge, and they're fearful of risking 1%, or they will miss out on an opportunity for a trade that they waited days for because they don't want it to be a loss, especially if they're in drawdown. Whereas I'm like, well, look at it as like if you're an electrician or a plumber, you don't just have one tool. You have like 3 or 4 wrenches, a whole kit of screwdrivers. They all do the same job. If one wears out, throw it in the bin, you've got another one straight away. You've got to make sure that you're only investing what you can afford to lose, so everyone's different from that standpoint. But it's a case of buy multiple accounts and then alternate them. So again, if you're trading one asset, so if you're only trading ES, buy 2 challenges and alternate your trades between the 2 accounts. I was doing that for a while. And then I'd implement another asset. So I'd trade the German DAX on one only, and then ES or S&P 500 on another one, and then I'm just trading them both. One will pass, one will take a little bit longer, or maybe go into slight drawdown. And I started to accumulate accounts quicker than I expected. It took me about 2 to 3 months to get any kind of allocation. But then as soon as I had it, it was like trading live with another evaluation, and then trading 2 live with another evaluation. Just constantly keep it going. Look at it as like a production line.
Yes. Are you doing it manually or some sort of copy trader?
No, manually. I've not used a copy trader until very recently. Always trading them manually, kind of one account at a time, and then on an account rotation. So when I had allocation with FTMO and FundedNext and Funder Pro, a few others as well, Alpha Capital, Aquafunder tried them as well, and I'd be on rotation, and one day I'd be like, right, I'm going to trade a live account and aim to make some money today because the markets are looking fire, right? This is looking good. This is prime. I want to be aggressive. It's time to make some money. And then the next day I'd alternate that, part that payout, whether it's an instant day crypto payout from Funder Pro, A-book model, whereas if you've got a FundedNext or an FTMO, you're waiting 14 days for a payout. And then you're trading an evaluation during that process. And it got to a point where I'd passed millions in allocation, and it's a case of I can pick and choose what I'm trading, but I didn't want to put all my eggs in one basket, which is why I didn't use a copy trader. Whereas
yes.
Now with the futures space, this is that transition, because okay, I made 250k in payouts in 12 months, and that's great. And I could probably do that again next year. But to make more, it's not a case of being a better trader, because making 5% a month on average through the year is fantastic. 50, 60% a year, you're an incredible trader, right? You're in that top 1% bracket. And I'm a realist. I'm not expecting to make 150% next year. So it's just a game of scaling capital, like you say. So that's the one great thing with futures, is that you buy 5 or 6 Tradeovate accounts, so you link them together, and you typically are on a one phase, so it's lower entry. You've got a 6% profit target versus 25% over 2 phases, and the cost is also quite lower. But you've got to be more rigid because you're closing at the end of the day.
Yes. No, an interesting exploration. I want to speak about the prop firm journey specifically, because obviously each one has its own rules. In the CFD side, everyone has this little no weekend, no news, this, that, and the other, and then payout restrictions in terms of time, and then reduce risk and so forth. Anything that you'd like to share with the viewers in terms of, because I think everyone has their favorites, and usually that favorite is, I tried it once, had a good experience, I'll stick with it, and people don't often then pivot to explore, because there's a long list of prop firms you can try. What are certain firms you've worked with that have just been like, I get what I pay for, this is something I would continue to use?
Yeah, I mean, definitely FundedNext have been incredible. I'm about $88,000 in lifetime payouts from them, and that's just from a 12-month period. And there's not been one point where they've said, hold on a minute, we're going to look at your trading strategy, or we're not too sure if we're going to pay you out on that. They've not had to ask me to jump on an interview and me to prove that I can use MT4, MT5 or something like that, which I understand it's their risk protocol. Some firms do that, but I've never had any problems with that. And there are other firms like Funder Pro who are, I would say, more expensive on the challenge front and more difficult to pass because you've got consistency rules on the phases and larger targets. I think they've changed recently. But then once you're live, there's no consistency rule. It's A-book model. They want you to win, and they pay you the same day if you're withdrawing crypto.
That's powerful.
Which is really good, yeah. So it's definitely a trade-off in the crypto space. In the prop firm space. It's definitely a trade-off in the prop firm space, because it's either lower entry in terms of cost or easy to pass, but more difficult to get a payout.
Yes, which sounds worse to me.
Yeah, or just trade for 2 or 3 months conservatively, and then the gates open, and it's much easier to get a payout.
I finally have a special offer to share with all of you from the US, or my futures traders, which is over 20% of the listeners of the show, and that is Alpha Futures, a leading futures prop firm that is working with Tradeovate and NinjaTrader that are compliant with CME regulations. With the largest end-of-day balance drawdown in the industry, a 90% profit split and same-day payout, and with the most competitive pricing in the industry, with accounts starting at just $79. On top of that, just by being a viewer of the show, you get up to 40% off all evaluations. So why not get started with an evaluation right away, trading $50,000, $100,000, and you already know the power of prop firms and larger capital. So go ahead and use the link in the description or code TOT for the best prices in the industry, plus the best discounts in the industry, to make this a home run offer if you are a futures trader. Overall, as you pursue scale, capital will do the heavy lifting. What is your now experience with any personal capital or funneling these significant payouts? Are you funneling it into just reinvestment into more challenges, or now diversification in terms of business, or still maintaining personal capital?
I've got a diversification, so I'll use some for personal pleasure. I'll use some for long-term investments, pension pots, children fund. I'll use some into reinvestment into more challenges to keep the allocation going. And then fourthly, but not lastly, is back into another personal capital pot. So in the next 3 to 6 months, I'll see myself starting to trade personal capital once more again as an end goal, because it's like running the small fitness business that I had for a decade. Everything is running smoothly, feeling like me as the owner of the business, I'm in control of the reins. Well, no, the government is in control, and they can pull the rug and tell you to close, and there's nothing you can do about it. I've traded prop firms that have denied me payouts and I feel wronged. And I traded for 2 to 3 months and worked really hard and traded like a really disciplined trader. But then they have control to say, no, I'm not going to pay you out. Or the prop firm just goes bust. So I've always got that long-term perspective that it's a great tool now. And I'm still an advocate of prop firms. I think they're incredible. I'm still using them every single day. But you've got to look 2, 3, 5, 10 years down the line. Utilize the tool now while it's here, while it's hot, in terms of before they start to make their rules even firmer, because I feel it's going that way to protect themselves. Because yeah, there are more people in the trading space, but traders are becoming more profitable. So what's happening to the prop firm space? They're starting to lose money. So they're going to have to make their rules a lot firmer. So going back to nothing beats personal capital. So I've been through this journey and I kind of proven to myself more than anything else that I can make it work. And from an ROI point of view, I've certainly not spent $250,000 on prop firm challenges, that's for sure. Maybe more like $20,000 in a year.
So if you look at it as a risk reward in that sense, 1 to 10 is sick.
It's huge, right? Any investment in a year to pay you that, you'd snap the hand off.
Yes.
But it's time now to start growing that personal capital pot again and take control over my own capital.
I want to explore this idea of, because you are trading in appreciating indexes, you can obviously day trade it or swing trade it and generate an alpha between your own competence as a trader and analyst versus what the S&P or whatever it would do, maybe 10% a year, let's say. So that's your earned or active income. Have you considered just putting it in and just buy and hold to kind of be an hedge if you have a losing period, or at least you capitalize on the upside just through investing and maybe a psychological relief? Is that anything you're doing or exploring?
It's something I wish I did during the tariffs.
That's exactly what I did, which is why I asked it. It's just been the best thing for my trading. Because I was generating, it's a miracle, man. It just V recovery and had to do nothing apart from buy at the right time. But then it's just giving me relief elsewhere and not needing to chase the market and so forth.
Absolutely. I think it's a great idea, and I'm constantly on a learning cycle. Myself, I'm not the best trader right now that I will ever be, and that's an ethos that I've encompassed into my own trading ever since I had my back against the wall, even calling my education firm Evolution, because I knew that I would always evolve in life as a person, as a father, as a trader.
Yes.
So in 5 years' time from now, I don't want to be trading the same way as I do now, because I want to be better. So something's going to have to change, and I can't control the markets, but I can control how much capital I trade and how fine-tuned and how switched on and how much knowledge I have. So being able to network with other traders like yourself and just time on the markets, you can't beat it. Back testing teaches you some, but live trading is really unbeatable. So yeah, looking at trading indexes for a long run and how speculative it is, and usually when the mainstream media is saying the stock market is crashing is usually when the switched on traders are buying. And I wanted to start doing more of that.
Let's explore this word because we're talking about market experience and how through the experience patterns come up or tendencies come up, or you learn more about yourself as an individual, how you react in certain moments, and you build that muscle. But that can also transgress in towards intuition, and then intuition-based trading where the plan says X, I will still do Y because my intuition or gut feeling. Is that something you would deploy intuition, reading between the lines, or what is that place of market experience versus just a rigid mechanical plan?
Yeah, I've been through a journey where I tried to make a strategy 100% mechanical, and it works very well when the market conditions are there. As soon as the market conditions change,
there's no leeway.
It's almost like separate a 4-hour structure analysis and a 15-minute time frame entry model. If the 4-hour structure is in a good place for that 15-minute entry model to work, it's great. It's an alignment. But if you are in a different 4-hour structural market, or if it's a consolidation versus a trend, you can't plug and play the same 15-minute entry model into that market because you're going to lose. So that's where the mechanics are great in more the structure and the overall trade building and the entry model itself. But to put it all together, there's got to be some intuition involved, some discretion. It's looking at, okay, we've broke all-time highs. Yeah, but how have you broken all-time highs? Yes. Did we break all-time highs yesterday in impulse and have continued and are now looking to take liquidity and continue? Or did it break and within the same 4-hour candle retrace and close bearish back inside the range? You can't then plug in that same 15-minute entry model because there's two different higher time frame structure behaviors there. So yeah, there's certain things you can teach and there's certain things that you can mechanicalize, but there's always going to have to be some discretion involved. And then you've got fundamentals that plug in there as well. Like what fundamentals are this week? Like Monday, Tuesday this week, markets didn't really do anything because there was no fundamentals. As soon as Wednesday came about, the markets came alive again because there's fundamentals there to drive more volume.
Yes. As we wrap up the episode, I've really enjoyed it so far. I want to give you an open mic to explore advice for young traders in their 1 to 3 year mark, especially because you've had a very relatable story back against the wall, had to make it work out and so forth. Any lasting piece of advice you'd like to share with them?
I would say if you're early in your journey, if you are aspiring to be a trader, if you're kind of in that losing phase or if you're in that break-even stage right now, just try and simplify it as much as possible. Instead of having a watch list of like 24 blinkers on the side of TradingView, just narrow it down to 1 or 2. Try and filter your time frame so you've not got everything from a weekly right down to a 1 minute and everything in between at the top of TradingView chart. Try to look at one higher time frame and one lower time frame. By lower time frame, you could be a 30 minute, it could be a 15 minute. Focus on trend. You don't necessarily have to focus on liquidity because that's subjective, but focus on trend. So trending asset should be, so look at indices if you wanted to. I see that as more reliable. And then look at trends and only trade with the trend. It's something that I would teach kind of anyone that looking to get advice from me. Okay, I'm selling in a bullish market, but I've experienced that. I want you to look at only buying in a bullish market, and the time will come for you to start hedging against that because that comes with experience. And everyone says this, right? Is focus on the knowledge and not the money first, but we don't listen. I was the same, like focus on the money first. So don't buy a prop firm challenge if you're not ready yet. And the biggest indication of whether you're ready yet is not necessarily back testing results, but how confident you are in a live market. Like open up a small personal account with even $100. Don't put lots of money in straight away, but just prove to yourself that you can stick to your rules. And if you can stick to your rules on a $100 personal account for, let's say, 2-3 months, then you've got discipline and patience as well as strategy to be able to plug and play that into a prop firm account and then trade that on an account that doesn't have trailing drawdown.
There we go. Scott, a wicked episode. I really enjoyed it. Thank you very much for coming
Great being
down
here.
today.
Thanks for having me on.
Amazing, man. Boom.